is this an attractive time to be buying bonds in some form or other? I see a world of inflation coming close to targets and the central banks shifting to an easier stance and the yields in some parts of the world being the most attractive that we've seen for a number of years. All of that comes together as a good time to be looking at the bond market.
Die Geldmeisterin. Der Finanzpodcast mit Julia Kistner. Okay, Iain, please tell us a little bit about your position at JP Morgan Asset Management. What are you doing there?
Okay, I'm the International Chief Investment Officer of the Global Fixed Income Currency and Commodities team. So my responsibility is overseeing the investment process for the international book of business that we run across our fixed income platform.
So you're the right person.
Hopefully.
How would you describe the bond market year 23 in a few sentences?
I think it was a very volatile year within the bond market. I think we started the year with a lot of expectation that bonds would do very well, given the hiking cycle that we saw during 2022. Bonds did do very well to start with, as we had concerns around the regional banking system in the US and some of the banking system within Europe. And we saw the core fixed income yields move lower in yield, up in price. So that was a very good environment for fixed income. But what you then saw during the summer months was that the policies that the authorities in the US had put in place, protecting deposits, money, had actually been the equivalent of an easing of monetary policy. And we saw a sort of re-acceleration in economic activity, concerns that inflation wasn't coming under control, which led to concerns that the central banks would have to do more. And you had that on top of the additional supply, so the additional issuance from the US Treasury to fund their deficit. So that really weighed on bonds, pushed yields higher and prices down, so a negative environment. So that was a very tough period in the middle of the year. And then we went full circle towards the end of the year, where it felt like inflation pressures were coming back under control. And we then had some positive news from the central banks that they were close to being done with tightening policy and that their next move would be actually cutting interest rates. That's obviously a very good environment for the bond market. So through November and December, we had a really strong performance from all types of fixed income.
And where do we stand now? Do you see these interest rates going down this year, just in Europe or also in the United States? And we still have the votes in America. Won't there be again a few turmoil? So does the market has to price in too much regarding interest rates?
I think the reality is we're likely to continue to see volatility in the bond market as the market gets to grips with exactly how the central bank reaction function is going to play out this year. But if you take a step back and think about where we stand today relative to this time last year, it's actually a very good opportunity strategically to buy into the fixed income markets. Because you've got inflation, which does largely look like it's under control.
But isn't.
And you've got central banks which have told us not to worry about more hikes, but that their next move is going to be cuts. Now, we don't know exactly when those cuts will be, but it's the direction of travel. We are no longer tightening policy. The next move will be an easier policy. That should be a good environment for fixed income, and with the current valuations that you have on offer, this is strategically a very good environment to be investing.
But when you look at the inverse curve, and it's already 6 or 7 months now, or 8 months, isn't this also dangerous signal for the market that the recession could come, and what would this mean for the bond markets?
So I think there's definitely recession risks. I think the biggest recession risk that was out there was that the central banks would continue to tighten policy or be unwilling to ease policy as economic activity slowed. Now, it does look like they are going to be able to do that, be proactive, start to normalize policy from a restrictive level to a more normal level, which should help to support economic activity. So it does feel like our base case should be the soft landing, which obviously is very hard to achieve, and history tells you it isn't often achieved. But it does feel like that's the direction we're headed. I mean, the risks are still out there, of course. Again, we have got tight policy. We know monetary policy works with lags. What will be the impact? We are starting to see signs of a slowing in the labour market. We've still got tight lending standards from the banking system. So there's definitely a concern about the recessionary environment, and you have to think about that as a tail risk. But if that does happen, that's still a very good environment for bonds, because what I think the difference again between now and this time last year is that the central banks have the ability to react. So if you do start to see signs of a recession, because of where inflation is and inflation coming under control, the central banks will be able to aggressively ease in the face of a slowdown. So actually that's an even better environment for fixed income because yields could go a lot lower.
But right now you see still a huge amount of tightening, or?
So at the moment, I think the next move will be easing. They've obviously tightened a lot. They believe they are in restrictive territory. And we've had comments from Jerome Powell back in December that they were talking about cuts. Obviously, the ECB has pushed back a bit on some of the market pricing, but Christine Lagarde has talked about the possibility of rate cuts by the summer. It does feel like the next move is going to be easing. There is a question around exactly when, but if the direction of travel is to easier policy.
And where exactly do you see these opportunities in the bond market?
So you mentioned the inverse curve. So historically, you would expect that curve to normalize. So the very front end is, some of that is maybe there's a little bit linked to monetary policy, and I see there's a lot of cuts currently priced in on the very front end. But the more intermediate, the 5-year part of the bond market, that looks pretty attractive to us, considering where yields are, considering where inflation is, and then considering that over the next few years we would expect monetary policy to come down. So possibly avoiding the very front end and possibly not wanting to be too focused on the very long end, given the issuance that's coming, but the intermediate part of the bond market looks pretty attractive. That
would be 3 to 5 years?
Yeah, I'd say 3 to 7 years.
3 to 7 years. And regarding investment grade?
I think investment grade credit is probably the real sweet spot from a bond standpoint.
Why?
Because you've got corporate fundamentals that still look very strong at the moment. You've got the additional yield pickup that you get from owning credit over governments. Now that yield pickup has narrowed given the rally that we saw at the back end of last year, but you are still getting additional yield owning investment grade credit. And then if we are going to that tail risk of a slowdown, high quality fixed income is what you want to be invested in. So really, I think that is the place that we would like to be allocating to at the moment.
And regarding currencies, do you prefer local currencies or US dollar or euro?
So if you look at where the value is across the investment grade credit market, it's in Europe. So we've seen US credit spreads move down towards the tighter end of recent ranges. So you're talking about 100 basis points extra to get US investment grade credit. But within Europe, you're talking about 140 basis points. So there's still a decent pickup to buy Europe over the US. Now, there are reasons for that. The European economy, as we know, has been weaker than the US. But I still think the fundamental corporate health in Europe is pretty good. So I think you are compensated for that additional yield. And then within the corporate market within Europe, you can actually look at other parts like corporate hybrids. You can look at some of the bank capital where you can get additional spreads of 250 to 500 basis points, depending on the name. Now, I would like our analysts to do some research and ensure that we are comfortable with buying those individual issuers. But if that is the case, then there are some really kind of attractive yield pickups you can get owning some of those corporates.
So, and which of these corporate sectors do you prefer? How much risk do you take there?
So, I mean, if the base case is a soft landing, and a central bank that is going to ease into that, then you should be comfortable taking risk. So I would take corporate hybrids. I would look at bank additional tier ones, contingent convertibles. I think you are being compensated to take that risk, and I think in a slowing, non-recessionary environment, that those yields are very attractive.
And as you said, you prefer the immediate duration of 3 to 7 years. So you have to have concrete idea where the interest rates and the inflation is going to.
So I do think the central banks will be easing policy back towards what they believe is a neutral level. Now, it's very hard to get an exact number on what is neutral. If you look at the Federal Reserve's own estimate of long-term cash rates, it's 2.5% or so. I think probably it's slightly higher than that in reality. But I can easily see them taking rates down to 3.5% to 4%. I think that's perfectly to be expected. And if we do have a slowdown, even lower. Similar for the ECB. Neutral rate's probably slightly lower. Maybe it's closer to 1.5% to 2%. So I think so there's meaningful cuts to be coming in an environment where inflation is under control. The question is inflation under control? Well, actually, when you look at some of the more near-term inflation data, so say the last 3 months or the last 6 months, it is largely under control. If you look at the core PCE number, which is obviously the Federal Reserve's favourite, the consumption number, then that's slightly below 2% over the last 6 months. If you actually look at the core inflation in Europe, we're about 1.2%. That's well below the ECB's target.
Except Austria. There we had 7.8% inflation rate last year, and now we're about 5.4%.
But you're looking at it on a year-over-year number.
Year-over-year.
So if you look if you just look at the last 3 months, inflation is coming down very quickly. And what you can't wait for is for the year-over-year number to be exactly where you want it to be. The central banks need to be forward-looking. And actually, this is one of the questions that was asked to Jerome Powell. Do you need a year-over-year number at 2%, or can you have a 3-month or 6-month number? And he said it's the more near-term, so a 3 or 6 month number heading towards 2% is what they're looking to achieve. And they've largely got that. So that is why we are talking about cutting policy, because inflation has come to a level where the central banks believe they have effectively tamed the aggressive price rises that we were seeing 12 to 18 months ago.
And even if you invest for 3 or 7 years, which inflation is important for you? Is it for a bond investor? Are you thinking of taking the bonds until maturity? Is it really important how long the perspective will be for 3 or 7 years?
I think that is very much dependent on what the objective is. So we have a number of clients that will take the bonds to maturity. They will look to buy the bonds and they will look to own them through maturity, and then they have exact knowledge about what the cash flow will be and what the yield they're going to achieve. We have other clients that will be in some of our fund products, which are looking for us to make some decisions for them, so looking for us to dial up and down the duration of the products. So I think it really is down to the individual investor as to what they are looking to achieve. I always like to take a step back and just think, is this an attractive time to be buying bonds in some form or other? And I see a world of inflation coming close to targets, and the central banks shifting to an easier stance, and the yields in some parts of the world being the most attractive that we've seen for a number of years. All of that comes together as a good time to be looking at the bond market.
And bonds in Europe won't have a lot of competition from shares?
So there's always competition from shares, and again, it depends on your your time horizon. and your outlook and the risk that you're willing to take. Again, I wouldn't claim to be an expert on the equity market, but if you believe that there is a soft landing, then there is going to be a place to own risk markets. But when I look at where the yields are today, I think you can get comparable yields on some parts of the fixed income market. So if you look at, say, European high yield, for instance, a yield of north of 6.5%, that's an equity-like return profile with the volatility of the bond market. That's got to be an attractive investment for a number of people. And
how do you see the bond market in United Kingdom?
It's a more challenging one than maybe Europe and the US. I think the Bank of England have got an interesting task on their hands because inflation hasn't yet come down quite as quickly as they would have liked, and because when you look forward, we have spring budgets. It's an election year, which you typically fiscal spending. So there is a question about how quickly inflation will come down in the UK, maybe relative to Europe. I still think we will see easier policy from the Bank of England later this year. So in a sense, I still think it's probably a good environment to be looking at the gilt market. But if I had to pick favoured government bond markets around the world, I would probably prefer Europe and the US over the UK.
US, even though they also have an election year.
They do, but I think more importantly, at least for now, the inflation pressure in the US is coming under control, and the central bank is going to be probably earlier in cutting policy than the UK.
And once again to the US, don't you see the problem with the debt ceiling there, or doesn't this affect the bond market?
It does. I mean, we have debt issues all the time in the US, in the bond market. Always, it always just reacts to what is going. I think the interesting thing from a US side, again on the fiscal, is the deficit. But as we saw through the back end of last year, there was concerns about the additional supply of treasuries. But if you do feel that policy rates are coming down, suddenly there's a lot of demand for fixed income. And we've seen that at the beginning of this year. There's been a lot of supply to the bond market in the US. There's been a record supply in Europe. Yeah. It's all been absorbed very well.
Oh, okay.
I think there is an expectation that these are good yields. These are yields that people haven't seen. And these are yields that might not be around for much longer. So we should be investing now.
Back to the Eurozone again, the spreads between the countries are not quite high right now, even though Italy has different depths from Germany, for example. Do you look at the spreads right now?
We do. And actually one of our favoured positions at the moment is parts of Europe and the spreads that you're getting on places like Italy and Spain. And again, that comes back to a view that more accommodative policy, a non-recessionary environment. I know Europe's been kind of bumbling along at zero growth, but if you do start to see a little bit of recovery there, it should be very supportive for places like Italy and Spain.
So you take the additional risk for this country?
Yes, you do get reasonable yield pickup. Depending on the day, 160, 170 basis points for only Italian debt relative to Germany, all-in yield of close to 4%. With inflation in the Eurozone is coming down towards 2%. That's a nice yield pickup that you're getting only in Italy.
And are such small countries like Austria interesting for the bond market because they also have a spread to Germany?
I think they're all interesting. There's obviously there's a question of liquidity depending on the size of the bond market. But it's a general theme that we have that actually the opportunities in Europe, whether it's investment grade credit, whether it's some of the sovereign yields relative to Germany, they all look pretty attractive.
And what about the CE countries which don't have the euro?
So again, it's a question around what is the inflation profile looking like, and how are the central banks going to react to that? And the CE countries on a whole, not too dissimilar to what's going on in Europe. We are seeing inflation coming down, and we think the central banks will be easing policy there. So we actually own CE bonds as well for that reason. I think it's a general theme globally, not just the developed markets, but globally inflation is coming down from very high levels. So across the emerging markets, we've actually seen those central banks already start the process. So we have seen cuts in CE, we've seen cuts in Latin America. So we're already starting to see that normalization, which again, should be good for the bond market.
In South America, are you looking for countries which have less debt? Or what are you preferring in the emerging markets?
Within emerging markets, we're looking for countries where we get high real yields. So the yield that you get on the nominal bond relative to where inflation is expected to be. You're getting some really quite attractive real yields in places like Latin America. And we're also looking at central banks where we believe that they will be able to ease policy.
Not Argentina.
But it is a case-by-case basis, and there will be some countries that you want to own now, and maybe the market will price in the good news, and then you want to be shifting into another country. But I think on a whole, if I take a step back, the emerging markets have already started the cutting cycle. They were early in the hiking cycle. They're early in the cutting cycle. I think that's going to be good for their bonds.
And regarding volatility, is it higher in the bond market than in the stock market?
So we obviously saw elevated volatility last year. I do think we're likely to still see volatility in the bond market, but I think volatility overall should come down because the volatility last year was because we just didn't know when the central banks would stop hiking rates. And it feels that the central banks have stopped hiking rates and the next move will be easier rates. That should bring down bond volatility. But there's still a lot between today and when they cut rates for the first time. We could get some volatility as the market tries to figure out exactly when that first cut will be.
Yeah. And finally, would you agree that it's more difficult to get an overview over the bond market than the stock market?
Of course, yeah, definitely. If you look at, it's just the size and the scale of the bond market. So you've got all the different sectors. So government bonds, emerging market, credit, investment grade credit, high yield credit, the securitized market. You've all got all the different countries around the world. Within the credit market, you've got different parts of the capital structure. It's just it is a very complex market.
Thank you, Iain. It was very interesting.
Perfect.
Alles Gesagte ist nur die persönliche Meinung von Julia Kistner und daher keine Anlageempfehlung und keine Rechts- und Steuerberatung. Für Verluste, die aufgrund von getroffenen Aussagen entstehen, übernimmt die Autorin Julia Kistner keine Haftung.